One of the fundamental concepts in finance is the concept of present value and the concept of future value. In order to understand present value, what we're going to do is to first examine the idea of a so-called zero coupon bond and then relate that to the concept of present value. Now, often in a number of textbooks, you just get a formula for what the definition of present value is. Indeed, many of the financial calculators have a button that you press to calculate present value or PV or future value, FV. That's not my approach. What I want to do is to give you the fundamental intuition behind the idea of present value. So let's start with the idea of the zero coupon bond. Now, this bond, actually, we've already been introduced to earlier. We've been introduced to the idea of a treasury bill, which is a simple form of a zero coupon bond. A treasury bill does not pay a coupon. It is priced at a discount from $100, which is often called a par value. So a discount from par. The treasury bill itself is often quoted in terms of a discount basis. So people quote the treasury bill at 10% discount, which means that it's trading at a price of $90. Do not confuse the discount with the rate of return that you would earn on the treasury bill. Indeed, we've already been through an example where the rate of return on a $90 investment for 1 year is 11.1%, not 10%. But it's just a convenient way to quote a bond in terms of the discount. Now, actually, what I prefer to do is simply to talk about the price of the bond, and that's what I'm going to do today. So let's talk about the price of a zero coupon bond, and suppose that bond is 1 year to maturity and the price is $90, which is identical to the treasury bill that we studied. We know that the rate of return that we would get, or the true interest rate on this bond, is equal to $10, because we know that we're going to get 10, because in 1 year we'll get 100, and we paid 90. So the difference, 100 minus 90 is 10. Divide that by the initial investment, and we get the rate of return. Okay, so the formula for the rate of return is simply what you sell the asset for at the end of the year, subtract what you paid for it at the beginning of the year, and divide by what you paid for it at the beginning of the year. In this case, the return is 11.1%. Now, we can have zero coupon bonds of any maturity. It doesn't have to be 1 year. There might be a treasury bill that has got 1 month to maturity, a 30-day treasury bill. And actually, the treasury doesn't issue 30-day treasury bills, but if there's a 90-day treasury bill that's been sitting out there 60 days, it's got 30 days to go. So we call it a 30-day treasury bill. Its price might be $99. So the rate of return that you would earn over the 1 month holding period would be 100 minus 99 divided by 99. So a little over 1% for that month. Okay? There might also be a longer maturity treasury. So suppose we had a zero coupon bond that had 2 years to maturity. And suppose the price of that bond was 80. Well, we know that at the end of the 2 years we're going to get 100. The rate of return for the 2-year investment is 100 minus 80 divided by 80. So that's 20 divided by 80, which is 25%. Now, this is not to say that the interest rate is 25%. The rate of return that we will earn over 2 years is 25%. But usually interest rates are quoted in terms of an annual basis. So the interest rate in this case would be somewhere in the range of 12% on an annual basis. So let's say we've got these two zero coupon bonds. One is trading at 80 and it's got 2 years to maturity, and the other is trading at 90 and it's got 1 year to maturity. Okay. So these are the prices that the market sets for these types of cash flows. Now, suppose that I'm independently looking at a series of cash flows and trying to evaluate what the value today, or the so-called present value, of these cash flows are. Now, somebody tells me that there's an investment out there that's available, and it's got the following cash flows. At the end of year 1, you get $100. At the end of year 2, you get $100. And that's it. So it's a very simple project, and there's no risk to the project. It's guaranteed. $100 next year, $100 in 2 years. Those are the payoffs of this project. Now the question is, what is the value of this project today? Now, obviously, the value is not $200, right? Because you would much prefer to take the $200 to taking this project. So if you were given the choice between $200 and this project, nobody would choose the project. You'd always choose the $200. So how can we go about valuing this particular project? Well, it turns out that we can use this information that we have about the zero coupon bonds to help us understand the value of this project. Now, I already told you that I could pay $90 today to buy a 1-year zero coupon bond that would pay off $100 at the end of the first year. And I could pay $80 today to buy a 2-year zero coupon bond that would pay off $100 in 2 years. Notice that the payoffs of these two zero coupon bonds are identical to the payoffs of this project. So this is actually something that is referred to as a replicating project. So I've got two investments. They have the identical payoffs. It turns out that I know the value of the zero coupon bonds. So if I buy one for 90 and one for 80, I've spent $170. With $170, I'm going to get 100 at the end of the first year, 100 at the end of the second year. So in terms of the marketplace, I can exactly replicate the payoffs of this project that I'm trying to value with these zero coupon bonds. And the replication cost is $170. The question now is, what is the value of this project? And I told you that this project had no risk, so the cash flows are guaranteed. The cash flows of U.S. government zero coupon bonds are also guaranteed. I've got two projects. Basically, you could consider the bonds a project. You could consider this investment project a project. Two projects with identical cash flows with probability 1. An important concept in finance is that projects with the same cash flows, with the same probability, must have the same value today. This fundamental concept is known as the concept of no arbitrage. If there was a different value in these projects, there would be arbitrage. So what do I mean here? I'm suggesting that the value of this project, with $100 cash flow at the end of the first year and $200 at the end of the second year, is $170. And it doesn't make any sense that it would be valued higher or lower. Suppose that it is valued higher. Suppose that the person selling this project to me says the price is $180. For $180, you get $100 after the first year and $100 after the second year. Am I going to invest in that project? No way. It doesn't make any sense for me to do that. And the reason is that I can get the same cash flows, the same $100 at the end of the first year, $100 at the end of the second year, by investing in the zero coupon bonds. And they're only going to cost $170. So it turns out that the seller of this investment project is not going to have any buyers. So what is the seller going to do? The seller has to drop the price. And the seller will drop the price to $170. Now, it also goes the other way. Suppose that the seller of the project says, you can have this project for $160. So, if I think about that, $160 actually is a good deal, because that's way cheaper than paying $170 and getting the same cash flows. So I'm probably not alone in the market in figuring out that this is a good deal. So what's going to happen? Everybody's going to be bidding to invest in this project. And 160 is a good deal, but 161 is still a good deal. And so is 162, all the way up. And the price is going to go up until it hits $170. So by this idea of no arbitrage, or really no good deals, no great deals, that the price of the project today is going to be $170. The value of this project today is called the present value. Now, as I said earlier, I could give you a formula to calculate the present value, but it's much more important to understand the intuition behind the idea of present value. And the way that I've built this intuition is to consider cash flows that exactly replicate the project under consideration. Exactly replicate. The value of those cash flows that replicate the project must be the same as the value of the project by the principle of no arbitrage. Hence, the present value is simply the value of the replicating portfolio. In this case, it was a simple portfolio of 2 bonds. And the present value of the project is $170. Now, when you go through the lecture note, you'll notice that there are formulas for present value. And what we do is to take the cash flow next year and discount it back to present value. And really, all of this can be cast in the same framework as the replicating portfolio. So the $100 next year is going to be brought back to the present value. What is that $100 worth today? Well, we can figure out what the interest rate is by observing the zero coupon bonds. And the interest rate for the 1-year zero coupon bond is 11.1%. So if we take 100 and discount it back to the present by dividing by 1.111, we're going to get the value of 90, which just so happens to be the price of the zero coupon bond. And we'll do the same thing for the 2-year cash flow. We'll use the zero coupon bond to get the interest rate, which in this case is about 12%. Discount that back to the present, and the price is going to be $80. We take 90, add it to 80, 170. So So the formula is giving us the exact same number as what we deduced by using the zero coupon bonds and creating the replicating portfolio. So this concept of replicating portfolio is going to be important in finance, because often it's the case that we've got very complicated projects with cash flows that change fairly dramatically through time. And it's difficult to actually value these projects by conventional methods. So one trick that people use is to create another portfolio of securities that are freely traded and prices are available. And this portfolio mimics the cash flows of this complicated project that we're trying to evaluate. And it turns out that this delivers the present value or the value of the project. So the idea of replication, the idea of no arbitrage are fundamental in valuation and fundamental to the intuition of present value. Now, I said I would talk also about future value. Future value is just what the cash flow is worth in the future. So if I've got a zero coupon bond that has 1 year to maturity, and the value today is 90, the future value in 1 year is 100. The present value is 90, the value today is 90, the future value is 100. The 2-year zero coupon bond, if the present value is 80, the future value is 100. So it's just a matter of where you look at the timing or the value, whether you're standing today, whether you're standing tomorrow, or next year. Now, one more thing on the replicating portfolio. The example of the project that I gave was an example where you knew the cash flows for sure. I said that there was a probability 1 that we would get $100 next year and $100 2 years from now. And therefore, we could look at the U.S. government zero coupon bonds and establish value. Now, most projects don't have the luxury of having cash flows that are known for sure. What do we do? Can we use this technique, or is this technique a special technique that's only relevant to an example with unrealistic assumptions? Well, you probably guessed that we can use the technique. Because the technique, if I show you a technique, it should be able to be generalized, or it's not that useful in deducing any intuition about the main concept. If the cash flows are risky, then we have to mimic the cash flows with bonds that have the same risk as the cash flows. So if we're not quite sure we're going to get $100 next year, then we can always use a corporate bond that has some risk that you're not going to be paid next year, rather than the U.S. Treasury zero coupon bond. So this is generalizable in terms of evaluating projects by this replication idea and the no arbitrage idea. So this is the essence of present value. This is the essence of future value. It is what we believe the project is worth today, given the interest rate environment, given the prices of other securities that we could potentially use to replicate the cash flows of this particular project. It's the value today that is the so-called equilibrium value, in that people are indifferent between buying the treasury bills or investing in this project. It is the present value.